we're joined by Charlie Osborne, CEO, founder of the Finance Squad, which is an outsourced accounting firm working primarily with construction businesses. Thanks for joining us today, Charlie.
Thanks for having me. Appreciate it.
Today, we're going to get into cash versus accrual and some of the tax strategies that contractors should be looking at as they're growing and scaling their companies. And so I figure we start off with a key question. At what point should a growing contractor start seriously thinking about moving from cash to accrual accounting? And why does waiting until you're forced to often create problems for them?
It's not always a revenue number. Usually, and if I were to put a revenue number around it, usually around 10 to 15 million. Which is usually sooner than what most companies do. A lot of times they wait till they're forced to from the IRS. And the reason why you may not want to do that, there's a couple of reasons, and it's because generally there's a difference between cash and accrual. Obviously, your cash, as jobs are happening, you may bill or you may front load a project with general conditions, other things that you get the money up front for, but you may not actually have the expenses tied to that till later in the project. I see that quite a bit. A lot of contractors will do that to help fund the initial startup costs of the project. The reason why that kind of hurts is because later down the road, you are going to see like this cash shortage. So there's two different things when we're talking about from like your accounting perspective, and they get confused quite a bit. And it's your cash flow versus your profitability, and they're two completely different things. And where a lot of people get hung up is exactly that. Is you're talking about guys care about cash. They want to see, hey, well, do I have the money to go pay my payroll or go get this equipment or whatever it is? Well, then it comes with profitability. They're not tying their revenue to their expenses. And so month to month on an accrual basis or on a percent complete, you can see, hey, here's how much we billed this month and here's our costs that are tied to that. In construction accounting, it's often called like over under billing. So if you bill ahead of time, you're actually not recognizing that revenue right away. You're just helping get the cash in the door, if that makes sense. Now, here's the thing is like from a tax perspective, and I may be jumping the gun a little bit, but from a tax perspective, you can do both. So like you can file on a cash basis, but you as a business owner, you want to be looking at how much profit is my business actually doing month to month versus how much cash we're bringing in. So we can talk about the tax stuff later, but my point is when you're actually talking about the profitability, it is a different ballgame. So generally it's a complexity thing. So like if you're just doing short jobs that are 30 days, it's not a huge deal. But once you start into 3 to 6 months and you got like 3 or 4 of those going on, you're going to see these like peaks and valleys in their financials. And well, you want to be able to kind of like stabilize that over time because, profit margins aren't huge in construction. So you may get 10%, 15% margins on some of this, and some of that's going to be retainage too. And so you have to really be able to manage that cash flow separate from managing the profitability. And so that's why looking on an accrual basis, when you get to the 10 to 15 million is probably it, but especially when you get to complex jobs where you're running 3 to 6 months out plus, sometimes a year and a half out. That's when you really want to start looking at moving to accrual, and that may be at 7 million for some people.
Yeah. Before we get too far into the tax stuff, can you break down, dig in a little bit to what blind spots does a contractor have if they're still using cash basis when they really should have kind of moved over to evaluating things on an accrual basis?
Yeah. So number one's generally like overbilling up front. Then they're kind of if you're not paying attention, which a lot of times as a business owner, you're going you're like, hey, this is what's making the money, right? So you go bill, the example I gave earlier, where you bill a bunch of stuff up front in anticipation. A lot of times just subconsciously people think like, oh, well, that's my margins on the job. But at the end of that project, you may not have any income coming in or actual cash coming in if you're on an accrual basis. But on a cash basis, you may not have any income. And you have all these expenses tied to that job still. And so that's why it's like really important to understand like the blind spots of staying on cash basis as a GC on these longer term jobs. If you're not really careful and you're not watching it, it's really hard to make business decisions at the end of the day, right? So like I'm big, no matter what business, no matter what industry, you want to make sure that, as the business owner, the CEO, or the decision maker, that you're looking at those financials every month. contractors are very good at what they do, but one thing that I work with on the CFO side is I try to help them understand what it is they're looking at, because not all of them went to a business school or have a lot of experience on the business side, and so they're really good at going and getting the jobs and doing the thing they're really good at. But I spend a lot of time helping coach and try to figure out, hey, well, how do we take this information and how do we get rid of those blind spots, and how do we make it usable information? Because a lot of times, especially on a cash basis, it's not really useful information, to be honest.
Let's dig into the tax part of it a little bit. So you mentioned that you may file on a cash basis while you're evaluating your business the rest of the year on accrual basis. Talk to me a little bit about how you evaluate that for contractors and what that actually looks like in practice.
Yeah, so it takes some coordination with CPA firms. Sometimes the CPA firms will kind of keep stuff separate from a cash basis. So a lot of the systems we can kind of toggle between cash and accrual. If you're doing it properly, it's pretty easy to figure out cash versus accrual. So at the end of the year, we can create financial statements on a cash basis and give them to the CPA firm so they can do their taxes. But the big advantage is if you're not forced over to your percent complete or your accrual based accounting, sometimes it is way more advantageous from a tax perspective to keep filing on a cash basis. And the reason for that is if you have these jobs that are drawn out, or if a lot of times the bigger banks, sometimes they take a while to pay, or if you're a subcontractor on a job, or you're not getting paid for 30, 60 days. And then you get into like government type of contracting on top of that. So if you're doing anything for like a city, they take forever to pay. So if all that revenue, if you're on an accrual basis and you're capturing all that revenue like towards the end of the year, but you're not getting paid on it yet, now you're going to be stuck with a higher tax bill on cash that you don't have, right? So there's some of that, and every situation is a little different. But there's the cash, if it's not super complex yet and you're not forced over. Sometimes we do that with clients. Sometimes we say, hey, like it kind of nets out year to year. At the end of the day, there are some advantages to staying on cash when you're smaller, and it's like around 10 million or so. It'll even out. But if you have some crazy projects coming up, or if you're in a certain type of construction where your payments are getting drawn out longer than you'd like, sometimes the cash stuff will be better if you're not forced over there.
Yeah, that's the trick. Is it always technically will even out, but that's not the problem. The problem is the timing of it evening
Exactly.
out. How does accrual accounting change the relationship contractors have with like banks and project owners, and also like how does it affect bonding when they start thinking about that?
Yeah, I mean, to be honest, banks bring us into the picture quite frequently when they have a client that they want to be able to get a loan, but they can't because they're on a cash basis or their financials don't look great. And this goes for any organization, an investor, anything. When they're looking at financials, they want to see accrual because they can make decisions. They can see, here's my revenue, here's my cost for that revenue. And then here's my expenses too. The thing that gets people is like when you start seeing your operating expenses as well, kind of doing this kind of, the roller coaster month to month, that's a key indicator that we're on a cash basis. And so that's the first thing I look for, because generally what you would see is you may see some stuff falling in line with revenue growth or shrinkage, but for the most part, you would see like it would be a percent of revenue, like fairly even, maybe some nuances here and there. But most of the time, what you're going to see on a cash basis set of financials on the income statement, you're going to see just these peaks and valleys on basically every line item month to month. And so that, when banks are looking at it, it's unpredictable to them. So they can't say, oh, well, that's a normal month of expense. That's a normal month of revenue. They're saying, I have no idea. It's volatile. And investors, banks, bonding companies, they don't like volatile, right? They want to see something that is predictable, and they know that they're putting their money in a good spot. Whether you're trying to get a loan or anything, and I do it all the time with companies trying to get loans. I'm talking to banks all the time. That is the number one thing. And it's even harder as it is just as a general contractor to get a loan or work with banks, period. It is one of the hardest industries to do that with. And so if your financials aren't set up on top of that, it's going to be nearly impossible. Being on an accrual basis helps significantly because we're already, going up against the big dogs and kind of have an uphill battle to start.
Yeah. Yeah. You mentioned earlier, and you kind of touched on it again, that if you're doing it properly, it's not hard to switch and switch back and forth. What does doing it properly mean? And also, like, what sort of support does a contractor need from the accounting system that they're using? Like, what capabilities does it need to have in order to accommodate that switch back and forth?
Yeah. So, I mean, the big thing is like job costing properly. I've seen some where they're just put it all into like their corporate, like revenue, and they don't really track the jobs. And I guess if you have a couple jobs, it's fine, because you'll probably know. But building in your work in progress. So again, on the accrual side, it's like knowing your over under billing, but also knowing like, hey, here's stuff that we're working on, percent complete calculations. Your retainage is a huge one. Revenue that you're recognizing, but you're not going to collect the cash for yet. So being able to account for that properly. And then just your job level gross profit analysis, like that's huge. But you can't do that if you're not putting the data in the system properly. And here's what I see with a lot of systems out there is everything's so like discombobulated with like different API integrations and all these other things and project, so finding one that can tie in your change order management, your project management, and APA, like all your billing, your draw requests, your everything that you would need to do in a system. If you can handle that in one place, there's not a ton of systems out there that I've seen that can actually do that. Crew Cost is one of the ones that I enjoy working with, because it is one of the few that actually can handle a lot of that. It does have some integrations here and there, but for the most part, it's like for most GCs, it is probably the best system out there for being able to manage it without overcomplicating. I think that's the problem. Is like some of these systems try to overcomplicate it, and then you get like the really really expensive systems, and they still like you spend a ton of money integrating it, and it still doesn't work properly because they've overcomplicated it. And so we have to keep in mind like who's using the system. It's like the guys that are in the field that are, like, do actually making the money for the companies. So like overcomplicating stuff doesn't help, because they don't care about the tech stack usually, to be honest. Like they just want to know that it works and it gets the job done and it gives them the information. So anyways, those are the key pieces of on the accounting system piece. Like it's simple is good, but it also has to have enough to be able to actually track the projects properly without losing data. The data integrity is huge too. So
Yeah, appreciate that. So last question just to wrap it up, if you were advising a contractor that's getting close to that threshold, they know they're going to hit that threshold next few years where they have to switch over to accrual accounting, what would you tell them to do right now to prepare for a smooth transition into that?
Cleaning up the job costing now, because here's the thing: is like you probably have jobs in progress, right? Deciding which ones we're just going to finish out as is, and which ones we're going to kind of start doing properly to me at least. If you're making money, that's great, that's proper. But for me, I like to see it on the accrual. Getting your WIP schedule built out and making adjusting entries. So like some of this is kind of nuanced, because you're like, okay, well, timing, amount of fiscal year, calendar year. Do I just wait till January? Like, so there's a couple things you can kind of think of, and then make some adjusting entries. If you're going to do it on a tax basis, you have to notify the IRS. So there's some forms you have to file. So you kind of want to plan ahead as well, because you can't just like switch and not tell the IRS your new method of filing taxes, right? So when you do that, you'll want to coordinate with your CPA as well on the tax side. And then, even if you're not making the entries on the WIP schedule, at least keeping up with it monthly, just so you have it ready to go. Because like, get a new job, it's much easier to like add it to that than it is to go back and recreate everything all at once when you already have a bunch of changes going on. And then figuring out which accounting system, like if you're not already on like an accounting system that can handle this, like evaluating and figuring out which accounting system is going to be a good fit long term. And then also just communicating it. So like communicate with your team, if you're outsourcing it, or your internal team, to who it's pertinent at least. And then also especially your CPA on the tax side, like I said. And then that'll kind of determine. I always tell people, like, try to think 2 to 3 years ahead. If you're good, we do a lot with acquisitions as well, so we help companies get acquired. And like the biggest thing that we see is hey, we got to do a cleanup. Any industry, any size, big and small, it doesn't matter. And it's like, well, we just been running cash. We just like kind of put stuff in the bank account for like, they've been doing it for 20 years or whatever. It's fine. Like they've been making money. They're very successful, but then they want to sell and it goes, okay, well, yeah, no one wants to look at our financials or work with us because, they can't actually tell a predictable model based on what we have on a cash basis. And so you got to think like 2, 3 years ahead. Am I going to need a loan? Am I going to want to sell my company? Am I going to want to do a merger? Am I going to want to, whatever it is, you got to think 2, 3 years ahead because they're going to go back 2 to 3 years. Whatever you start now is something that someone could be looking at in 3 years and say, oh, well, I'm glad I did it then and not have to go back and pay for someone to redo all my financials basically. And we've had to do that probably more times than not, to be honest, when we start with a company.
Yeah.
Usually it's like a trigger event. Yeah, like, hey, hey, I really need this like next week. And it's like, well, I got to do 3 years of financials all over again, I can, so then I give them options. Like we can do this like the very detailed way. We can give you the high level. Like there's, we try not to make it too expensive for them because it's like another cost, but at the same time, we want to make sure that it's accurate. So it's, those are the things like you just think 3 years ahead of what am I going to need? What am I going to want then? Like, even if I don't think I'm going to, like, what are the possibilities? So those are the big ones.
That's great advice. Thank you so much for your time today, Charlie.